Governments are lying to you about everything.
Mm.
They have a vested reason to push the price of gold down because that supports the currencies that they issue. We live in a Ponzi scheme that has to be fed new capital every day. You asked, how do you take advantage of the situation? And my response was, you're not going to take advantage of it. He who loses the least wins, because we're all going to be losers in this. Just think about the Great Depression. It took 25 years for the stock market to come back. So this is going to be a long slog, and the easy life that we've had to this point is going to change drastically. I think any day that you wake up now, you can see a financial meltdown.
All right, Bill, thank you for being here, first of all, but you don't really need an introduction, so let's not lose any of your time today on that sort of thing. And you're sort of an end of the world as we know it type of guy, as far as I understand it. And there's plenty of explanations. You've got plenty of reasons for that, plenty of videos online of yours as to why you're in that camp. People can also go to Bill Holter.com, I believe is your website, and see more of your videos. But what do you do with that conclusion practically? Like, how are you positioning yourself to take advantage of what's to come, or at least not be hurt by it?
Well, first off, yeah, I do believe that the world as we've known it is going to change drastically. I'm in that camp, if you will, originally just because of mathematics, the logic of it. I mean, we live in a financial system that mathematically cannot continue on the same path. Then in the last, call it 5 years, from a social standpoint, society's breaking down. I mean, people have lost their minds. And then you can also add in what governments have been doing over the last, call it 20 years since 9/11. I mean, governments have gotten more and more tyrannical. And I think we're at the end game of that. So, yeah, I am in that camp. I do believe the world is going to change drastically compared to as we know it. And I don't think anybody, there are some that the ones that are perpetrating this believe that they're going to benefit from it. But I don't think anybody's going to benefit from it. I don't think anybody's going to take advantage of it. I think you could go back to Richard Russell's, from a financial standpoint, he who loses the least wins, because we're all going to be losers in this.
I want to go back to, again, how do you deal with that more practically? But something that you said there is that mathematically the world cannot continue as it is. What I'm seeing right now, a couple of things that I'm seeing that aren't changing, maybe for the better. You feel free to tell me that that's not true, but domestic liquidity potentially is bottoming out now and on the rise, as well as deficit spending and potential rate cuts on the horizon. Wouldn't it make sense to sort of be, focus on risk on assets again, at least over the short to medium long term?
Well, you mentioned risk on assets, and the bottom line is, here now and today, going forward, you should look at return of principal as opposed to return on principal. From a mathematical standpoint, you're saying liquidity is bottoming out, so liquidity is going to go up, and deficit spending is slowing, and deficits are going to stop. That's an impossibility for deficits to stop. We live in a Ponzi scheme that has to be fed new capital every day. And if the new capital doesn't come in, as in any Ponzi scheme, the whole system collapses. So they can't stop deficit spending. They're going to have to increase deficit spending. And I actually would take exception to that a little bit. I mean, here in the U.S., we're going to have a $1.5 to $2 trillion deficit this year. That's not normal. I mean, normal deficits up until 5, 6, 7 years ago were under $1 trillion or well under $1 trillion. So the deficit spending has exploded. From a mathematical standpoint, there's so much debt outstanding that it can never be paid back in current terms. I mean, if you're buying a 5-year, 10-year, 20, 30-year treasury bond or any debt instrument, those are guaranteed certificates of confiscation. Your capital is going to be confiscated through the lower and lower purchasing power of the currency that debt is issued in. So again, I mean, from a mathematical standpoint, it cannot continue. I mean, you're looking at it when you say liquidity's bottoming out, deficit spending is slowing. It doesn't matter because liquidity in current currency terms, as they increase the liquidity, what does that do? It dilutes the purchasing power of that currency. So we're in the exponential geometric phase of debt creation, and the financial world certainly can't survive without new debt, and the real world cannot function without credit, and that's where we're headed, is a credit crack-up.
Well, yes, and it's really about the way that they finance themselves. So, for example, the U.S. Treasury now is issuing more short duration T-bills, which basically, as far as I understand, again, correct me if I'm wrong, that pulls more money out of reverse repo, and it thus brings more liquidity into the financial system, at least over the short run. Again, emphasis on the short run. So how does that tie into what you were just telling me about?
Well, you're looking at short term. You're looking at 3 months, 6 months, a year, 2 years. By moving into or issuing short term credit as opposed to long term debt and locking the rates in, the Treasury made a huge mistake a year ago, 2 years ago, 3 years ago. They should have, for their benefit, not the investors' benefit, but they should have issued long term securities and locked those rates in. They didn't do that. So now the sliding scale of the amount of, or the interest rate that the Treasury has to pay has increased dramatically along with higher interest rates. And now the U.S. Treasury is paying over $1 trillion per year, soon to be $1.5 trillion, and then $2 trillion, and then it just keeps going and going. You can't have that. Spending over $1 trillion a year on interest is more than what the U.S. government spends on defense. And the U.S. defense spending is larger than all defense spending for the rest of the world. So again, it's a mathematical certainty that this cannot go on for 5, 10, 20 years, simply because the amount of tax receipts, and remember, asset prices are elevated right now across the board. They are starting to deflate. You've seen bonds deflate. You'll see real estate deflate, and the last deflation is going to be in the stock market, and that will lead to lower capital gains taxes. So the tax base is going to shrink. At the same time, the interest, the debt service is increasing. It doesn't work. We're already spending over 20% of tax revenue on interest, and it's like renting versus owning.
How long then do you think, because you said it's not going to continue for 5, 10, 20 years, but is that like, do you think it just continues for like 4 more years and then crashes or comes crashing down in the 5th year, or how do you look at it?
No, I think any day that you wake up now, you can see a financial meltdown. There were big problems in the Treasury market last week. You saw gold and silver move strongly higher. On Thursday, gold made a all-time monthly high on the chart. It made an all-time weekly high on the chart, and it made an all-time daily high on the chart. So gold was at all-time highs on Friday. We had a big spike on Sunday night. The shorts, the cabal, whatever you want to call it. Real physical gold was not sold Sunday night. Real physical gold was not sold yesterday, Monday, and it's not being sold today. Yet the gold price is down $150, $120 in that time span. They had to suppress gold because if gold was 2,300 or 2,500 right now, you would have a full-blown financial panic on your hands. And the reason you'd have a financial panic is because that then calls into question the value or veracity of US dollars and US Treasury bonds. In order for the US government to be able to continue to borrow, they are having a harder time. I mean, foreigners are not buying treasuries, they're selling treasuries. So you're not getting that uptake anymore. The bottom line is we're headed to a point in time where the trust in the US Treasury is going to break. And my entire lifetime, and certainly yours, US Treasuries have been looked at as the risk-free asset on the planet. Really, the only risk-free asset. They've been, the Treasury's been downgraded. It's certainly, you certainly could see a default one way or the other of either non-payment or just blowing the money supply to the moon and destroying the dollar and paying back at, pick a number, 10 cents on the dollar in purchasing power. There's going to be a delineation between treasuries as a risk-free asset and gold and silver as risk-free assets. And gold and silver are God's money. They cannot default. They cannot be debased. They can be diluted, and that's what you see every time you see a waterfall event where all of a sudden you get, in a day's time, you get 9 months of global gold production sold in 24 hours. Yeah, they can dilute it with paper, but they cannot bankrupt gold. And in the end, the paper is what's worthless, not the gold.
Who's they in this case? Because you said they are suppressing the price of gold. Who do you mean by that?
Who do you suspect it would be?
Well, I've seen some of
that question.
So
well, let me ask you another. Hang on. Let me ask you another question. Do you believe that there is suppression or manipulation of gold, of silver, of all commodities, of all stocks, of all bonds? Do you believe that we live in a free and fair and open market, or are markets managed?
Well, markets are definitely managed. We've also seen people are now potentially getting jail time for that. Most recently, actually, was this summer, I believe, that two of the top guys at what is it, Goldman Sachs or whatever it was, are potentially getting jail time for that. But I'm just wondering, who is that? Who you mean by they? Do you mean the banks? And how do they, if that's the banks, how do they benefit from all of that suppression that's going on right now, given again on the background of the liquidity situation that we just talked about?
First off, understand that traders at JP Morgan or Goldman Sachs or whatever firm, they are not the brains behind the operation. I mean, they're not the ones who have, they have a financial reason to do it because they get bigger bonuses.
Yeah.
But when I say they, I'm talking about central banks, I'm talking about sovereign treasuries, and I'm talking about the BIS itself, which is the head of all central banks. In order to keep their paper Ponzi scheme alive and going, and I guess you could say trusted, they have to prove to people that things such as gold, silver, wheat, oil, you name it, things are bad, paper is good. And we live in a world now where government is taking more and more control over everyone's lives. I mean, before the call, we were talking about the guy from New Zealand who got arrested for dumping raw data. And, you told me that in Europe, you couldn't go to the store, you couldn't go to the gym, you couldn't do this, you couldn't do that unless you had a vaccine card. That's the government taking your world over. That's the government's forcing you to do something that you wouldn't do on your own. So understand that when I say they, I'm talking about the powers that be, the money interests the central banks, the sovereign treasuries, the BIS, which is over and above all central banks. They have a vested reason to push the price of gold down because that supports the currencies that they issue for free.
Does that vested reason continue in perpetuity, or does it depend on the stance of geopolitics when it comes down to currency wars? Meaning, could they ever switch and be manipulating it on the other side, like manipulating it higher?
At some point after this whole thing collapses, I mean, you've seen central banks buying massive amounts of gold over the last few years. In particular, you've seen China and Russia purchase massive amounts of gold. Do I think those that have the gold would want to manipulate it higher? Yeah, of course, because if you own something, you want it to go higher. And they've been filling their coffers with gold with the knowledge that the Western system is going to collapse and they're going to be left with massive black holes of nothingness on their balance sheet once the debt defaults. So yeah, at some point in time, and is it 3 months, 6 months, a year? Is it 2 years, 5 years after the collapse where you see the central banks and the sovereign treasuries that own large hoards of gold? Will they push or try to push the price higher? Yeah, I can envision that. I mean, why wouldn't they?
But that would basically be a currency war by the people who don't have it against.
Weapon.
What's that?
Yeah, it's a financial weapon of those who do have it versus those who don't have it.
Exactly. Yeah, exactly. Okay, that's a good point. That was actually sort of a side question to me because when people say they mean all kind of different things. So some people are talking about the traders themselves, but that clarifies it. So if you think that growing liquidity cannot save us here in the next couple of years, I'm thinking about what could. And so I wrote down, could wars save us? Because it seems like you guys are again financing a couple of wars that are almost always pointless, but a couple of wars, and that's basically pushing pushing demand for dollars again. Could that in some shape or form save you over the long run?
Well, obviously, it depends on what type of war and how hot it gets. I mean, does the U.S. fight Russia? Do they fight China? I don't think so. I mean, at this point, from what I understand, I mean, Russia has weapons that we have no defense against. I mean, Russia has proven to have hypersonic, and the U.S. has had failure after failure of hypersonic tests. And we may find out very shortly. We've got 2 aircraft carriers in the Persian Gulf. China has sent 6 ships, so there's a potential problem. You've got drones, attacking U.S. forces over there. What if? And I'll just, here's a question. What if one of the carriers gets hit by a hypersonic missile? What happens to the dollar then? What's going to happen to the demand for the almighty dollar that's been backed for at least the last 50 years by the American military? What if the American military is not the most powerful in the world, which they were, 20, 30 years ago? What if that has changed? What happens to demand for dollars then?
I was mostly thinking about the money that you're lending into existence that will eventually have to be paid back, which again puts upward pressure on the currency.
But it gets paid back at lower purchasing. That's what I wrote a piece probably 8, 9, 10 years ago. The title was The Never Pay Model. And that's the model of the United States. Borrow money, promise to pay it back in dollars, but those are cheaper dollars. I just listened to I was out earlier this morning listening to the radio, and I don't even know if you remember the movie where the little boy was left at home and his family went to Europe.
Yeah, Home Alone.
It's called Home Alone, right? He went to the grocery store and bought, I think he bought 8 items, and it came out to $19.73.
Hmm.
And that was in 1983. Do you have any idea what those same 8 items cost right now today?
No idea, but
Take a guess.
it's an
Over
interesting guess.
$63. It's over $63.
Hmm.
So just since 1983, in terms of those particular foods, the dollar has lost 2/3 or better of its value.
Hmm.
And that's the never pay model. You don't, you borrow in today's terms and you pay back in tomorrow's terms.
Hmm.
And that's, you're asking, okay, uh, does, will more liquidity save the system? Will it prolong the system? Well, they did that in 2008, 2009. They flooded the system with capital. And what happened? Yes, the system was saved, but that was the last time you had a normal or strong balance sheet for any sovereign treasuries or any central banks. They basically blew their balance sheets apart then. Now, my question is, so if they do that, if they come out with lots of liquidity and they hit a fire hose like they did after COVID, is that gonna save the system? What is going to happen is then you'll have another big leg down in the currency values, or another way to say it is another huge bout of inflation. And when all is said and done, who's going to save the central banks and the sovereign treasuries this time? They saved the system in 2008, 2009. This time around, there's no white knight. There is no savior.
Gee, this kind of, by the way, sort of like my wife's motto is also the same: never pay back. She just likes taking money from me, but that's a different point, I suppose. Do you think that whatever happens here, do you think that depends on who gets elected in 2024, though?
I don't think it makes a difference. It really doesn't. The difference, I mean, if Trump gets reelected, I I personally think that he does have the American people's best interests. And when I say best interests, uh, he believes in the liberty of the population as opposed to the tyranny of the population. Can he fix the financial problems? No, because it's a mathematical problem and you can't change math, and the debt cannot be paid back in current terms. It's an impossibility mathematically.
And so what I'm thinking within those lines is basically two things. How does that get solved? When does it get solved? That's something we can talk about. But in the meanwhile, I'm also thinking and selfishly worried about my personal situation, because I'm a 20-something beginner basically when it comes down to building wealth, and I'm in the wealth accumulation stage of my life. And I'm thinking, can I not use that 2, 3, 4, 5 years, whatever it might be, short term, to build wealth and be better protected for when something like that comes? What do you think about that? Like, is it even doable? Can I even try?
Yeah, my advice to you as, a younger investor would be, try to get yourself into as solid a position as you can. You want to be in cash. You want to have liquidity. When I say cash, liquidity, I'm talking about the old days when gold and silver were cash.
Hmm.
You want to own gold and silver because when the credit bubble does burst and you have assets that are trading for pennies on the dollar, your gold and silver will have increased in purchasing power, and you'll use less ounces of gold, less ounces of silver to purchase those distressed assets. And I was taught early on, when I was probably your age or maybe even younger, the way to make money in real estate is when you buy it, not when you sell it. If you buy it right, if you buy it very cheap at a distressed level, at some point in time, you will profit. And that's what I'm talking about from a worldwide standpoint. If you're liquid, and again, liquid meaning you have ounces of gold, you have ounces of silver, the credit bubble busts, deflates, and you're there with cash, with gold ounces and silver ounces, and pick up assets that have crashed in value with gold and silver, which at that point would have higher purchasing power. That's how you're going to build your wealth. There's not enough time. This system is not going to last. I mean, by the time you put this thing out, which is tomorrow morning, who knows? Every single morning that you wake up, we're 72 hours away from the end of the world as we knew it. And I say that from two standpoints. Once credit ceases, the globe will spin 3 times and no markets around the world will open. And 72 hours also coincides with your stomach. If you don't have food on hand, where are you going to get it from? Without credit, nothing's going to function. Gas stations, grocery stores, nothing will function without credit.
Right. I guess I get that point, but it's maybe hard to believe for someone who hasn't seen it with their own eyes, and which is something that also gets me thinking.
Nobody's seen it with their own eyes. No, nobody has seen a complete credit collapse with their own eyes, because never in the history of the world did we have fiat currencies where there was no currency anywhere on the planet issued by a government. It was backed by gold or silver. The Great Depression happened started in 1929, lasted through the 1930s. The difference being we were still attached to real money. The money was real. Now the money's fake.
What I'm thinking, though, in the meanwhile, is when I'm looking at something like the S&P, I'm looking at the chart of the S&P, for example, and what happened in 2020 when people were also kind of panicking and saying that this is it. This is going to be, the big crash or the reset as we were waiting for it. But since that low in 2020, the S&P has doubled. And that would have been an opportunity cost for me where I could have doubled my net worth and be even better off. So how do you look at an opportunity cost, I suppose, would be a question here.
Well, what would you be holding today? Let's say you bought in April of 2020, and you've got stock. You had stocks until yesterday, and you liquidated everything. And you're thinking, look at me, I doubled my money. Where would you hold that money? Where would you be holding it today?
That's what I want to ask you. Do you keep it in your brokerage, or do you even keep it in the S&P? You don't sell because maybe it doubles again over the next 3 years.
Have you read the book, The Great Taking?
No.
Okay, I've posted it 2 or 3 times on my website. You can get it online, free. Just download it.
Okay.
Read The Great Taking. What that talks about is once this credit bubble does collapse, there's already laws in effect that will take your money from the bank in the form of bail-ins. Will take your money from your money and your stocks and your bonds if your broker goes down. Same thing with insurance companies. Those laws, and this is not speculation, this is not something that's on the come. These laws are already in effect worldwide, and it makes it legal for your monies to be used to bail out the institutions. So again, when I ask you, where would your money be? You don't want your money to be in a position where you could wake up tomorrow morning and find out, and it's gone.
So, well, you're basically telling me not to assume counterparty risk.
Exactly. And I've said that for 15 years or more, 20 years. And when I was a broker up until 2006, I was telling people, get your certificates out. And you'll never find a broker saying, take your certificates on things that you don't think you're going to trade, because brokers get paid on your assets. And how do they get paid? Your assets get lent out at interest. The broker makes money. The broker gives a little bit to the individual stockbroker, and everybody's happy. And the customer doesn't even know that his certificate or stock or bond or whatever was lent out.
Yeah.
So when the music stops and your stocks or bonds or whatever are lent out, are you really going to get them back? I don't think so.
But to your point, I mean, if this is there is compensation for counterparty risk, right? So if I assume counterparty risk, I
Not to
am
the
being
client, not to the client. If you deposit ABC stock in a brokerage house and you get a monthly statement and it shows you, I've got 1,000 shares of ABC, 1,000 shares of ABC, month after month after month. That's all you see. Meanwhile, behind the scenes, your broker has lent your 1,000 shares of ABC out
Mhm.
and gives a small portion to the stockbroker to try to retain those assets. They would prefer not to see you sell it, and certainly don't want you to get the stock certificate, because if you get the stock certificate, then they don't have anything to lend out. How do you think these companies are charging you $7.95 for a trade and being profitable? How is that possible? It's not possible unless they're lending your securities out, and that's what they're doing. And that's what they've been doing for years and years and years. It's a scam.
I just always assume they make money on the spread and that they charge for order flow, basically. Because I always thought that, because
No
my
way.
broker once asked me if they could lend out my stock to be shorted, in which case they offered to pay me. I said no for many different reasons, but whatever. I mean, then I assume they just don't do it.
If you have a margin account, which is the typical account that a broker will open, if you have a margin account, they don't have to ask your permission. You've already given them permission.
Mm.
I mean, I've had brokers come to me on various stocks asking, because they know I hold them in certificate form, asking if I'd send a certificate in so they could lend it out. They pay me, 8%, whatever, 6%, which means they're obviously earning double that.
Yeah.
And I mean, my answer is a standard no, because what I'm doing is I'm putting a counterparty between me and my asset. You don't want to do that.
Mm. Yeah, that's a good point. But
But that's the model. That's the model of the brokerage houses. That's how they are profitable. They're lending all these securities out. And what could possibly go wrong in a world with over $2 quadrillion worth of derivatives? Everybody owes everybody. And when one link in that chain breaks, the whole chain is cut in half. It's broken.
Right. So if you say assume no counterparty risk, and you then therefore assume that maybe the demand for gold or the sentiment around gold would improve, wouldn't it make sense for me, again, being in the wealth accumulation portion of my life, wouldn't it make sense for me to leverage myself towards that run up in gold and go for the gold miners?
You could do that. I mean, I'm an advocate that you should probably be 70, 80% in the real metal, and then take 20, 30% and put it into miners for that operating/financial leverage. Yeah, you will get leverage. The only problem is you've seen naked shorting for years and years and years in the mining sector, and that's why it's done so poorly. And I mean, that you can prove that's happened. Just look at some of the various smaller miners around the world that trade for pennies on the dollar, and then all of a sudden blow up to $1, $2, $3, and it's a short-lived event. But that's a short squeeze. It's a short covering squeeze. That's proof that there's been massive shorting in that sector. It's important, if you do use that strategy of owning miners, you want to look at the property. You want to make sure that it's a property that likely is pregnant with gold or pregnant with silver. Because in today's world, you're not paying very much for those properties, because gold in the ground, I mean, there's companies you could buy gold in the ground at $10, $20 an ounce. We're at one end of the spectrum, and we're going to go to the other end of the spectrum, where reserves get revalued much, much, much higher. I mean, go back to 1979, 1980, 82. There were companies where they weren't producing anything, but they had reserves in the ground, and they were trading for huge numbers because people were willing to pay for reserves in the ground. Today, nobody's willing to pay for reserves in the ground. So if you do move into miners at this point, you're, you're moving in at uh, the most ridiculously undervalued level in history.
Right. But well, I suppose not many people are willing to pay for reserves in the ground because those ounces are not worth much unless they can be mined profitably, right? Which with the current inflation environment is not always the case, and not for most of
But
those.
why can some of them not be mined profitably? Because they can't get the capital. They're capital intensive to be able to create a mining operation.
Right.
And what have, quote, you asked me before, the powers that be, what have they done? The banks have starved the mining industry
Mm.
for years, for, probably 10, 15 years now.
Yeah, that's right. That's one part of it. Then there's also growing red tape. There's community problems. There's labor issues, and so on and so
Right.
forth.
Right.
And so that would also be a question. I guess we're going back to the very first question that I asked here, which was what do you do with the knowledge that you have here? What do you do with it practically? And is that what you do with your own money? I mean, are you 80% physical and then a little bit of miners and a little bit of this and that too?
I'm probably lower than that because a couple of my mining positions have grown to large positions.
Hmm. Okay, good. So what do you look at when you knowing that those are the challenges when it comes down to the gold miners? What do you look at? What do you look for in a gold miner that you put in your portfolio?
Well, for myself, as I mentioned, I'm a ground guy. I'm a property guy. There's no sense in having an operation that can mine, 100,000 or mine 1 million ounces of gold per year, but they only have 5 million ounces.
Hmm.
I'd rather have an operation that has 10 million ounces of reserves and can only, is only producing 50,000 or 100,000 ounces per year, just enough to pay keep the operation running. Because at a later date, when credit collapses and the price of gold gets marked up many fold, think about the leverage on that situation versus something that's a current producer but small reserves.
Hmm.
So I'm a property guy. I look for gold, silver in the ground.
Right. You bring up a good point on silver there, but just and I'll go back to it, but just to sort of summarize is that you're looking for ounces in the ground that are currently being mined profitably, but not at an extensive rate, so that you're not selling them too cheaply, basically.
Right. Or even ounces in the ground that can't be mined
Hmm.
at $2,000 an ounce or $25 silver. Maybe they can be mined profitably at 2,400. Maybe they can be profitably mined at $30 for silver. If they're in a position where they don't stand any chance of losing the property and they've basically tied it up, that's your ultimate call option on gold and silver.
Hmm.
Because you have gold in the ground that theoretically you're not paying hardly at all for it because it's not profitable. And I'm willing to wait for them to dilute the currencies and blow the system up. Then you're really sitting on a gold mine.
Right. It's worth mentioning though that while that gives you more leverage to the upside, it's also exposing you potentially to more downside if there was a drop in the gold price or during a liquidation event. Maybe the tide the tide goes back and a lot of the boats are left in the mud, basically.
Right. But again, what I'm talking about here is a situation that cannot bankrupt, that is
Hmm.
not capital intensive, something that basically just has to pay for their mining license
Hmm.
year after year.
That's right. Yeah. Well, that's an important point. That's an important point that you make there. Let's go back to silver. You said silver. Well, we never really went into silver, so let's go into silver. What is when you're talking about gold, silver is being always being sort of it's little leveraged brother, if you will. Do you still expect that to be the case?
Well, the ratio right now is what, 82, 83 to 1?
Hmm.
The price ratio, it takes 82 ounces of silver to buy 1 ounce of gold. It basically comes out of the ground at 10, 11 to 1. So that's God's ratio. And man's ratio is 82 to 1. And I know which one I believe is correct and which one's not correct.
Hmm.
If you go back to medieval times, or go back to not even, I mean, after medieval times, go back to when the United States 200 plus years ago, the ratio was 15, 16 to 1 price wise. And the reason being, um, going back to medieval times, if you needed and I'll use dollar terms. I mean, obviously there were no dollars back then, but if you needed to move $1,000, you had to move 10 times more silver as you had to move gold. So it was discounted to 15, 16 to 1 to account for having to, move them on mules or move the silver on carts, whatever. So there was a natural and justifiable discounting to 15, 16 to 1. That's where we got that ratio from, because it's always come out of the ground and call it 10 to 1. Then you got, then starting in 1976, then you have financial futures, options, et cetera, that were able to move and control price. And that's when the real discounting of silver versus gold, that's when it really started.
Hmm. Well, but you don't have that anymore.
It's man-made.
Right. But you don't have that anymore. Like, we don't have to.
We don't have that anymore.
We don't have to move it that way with partial ownership of gold or of silver or whatever it might be. We just move it differently, right?
You're right. You use the word partial ownership. Who really owns it? Do you own it? If the system goes down tomorrow, do you own it, or does your institution own it?
That's right. It's the counterparty risk again.
Right.
Right. But what happens then? Go ahead.
What do you mean, what happens then?
No, I mean, what happens then to the price of silver and gold in that situation? Basically, what is realistically, what is the potential upside, basically, is what I'm wondering here. Again, I'm trying to make a calculation in my head as to what do I do with my own money. So I'm trying to figure out the risk reward here. So what's the potential upside?
Well, I recommend that people be, let's say you have a pie of money that you want to put into gold and silver. Because of the ratio, I mean, if the ratio came down to 40 to 1, silver has doubled the performance of gold as far as purchasing power or currency or whatever, however you want to measure it. If it comes down to 20 to 1, now you've got a 4 to 1 ratio. Silver's going to outperform gold 4 to 1. So I recommend that people be at least 70% in silver versus gold. And once we have if you want to call it a reset of prices across the board, and if you wake up and silver's at 40 to 1 to gold or 20 to 1, then you take some of your silver and you buy gold. And you'll end up with more gold ounces than if you just bought the gold ounces outright today. What you'd be doing is purchasing less expensive gold with more expensive silver, and you get more ounces.
Yeah. Okay. What do you think about the silver producers then in that case? Because there's just not many of them. There's not many pure play silver producers out there because of how silver is spread geologically, and it's often with gold.
Yeah, and again, you're talking about the smallest or smaller part of your portfolio. 20%, maybe 30%. If you could find good properties, good silver producers, I'm all for that.
Right.
But that's not the bulk of your portfolio.
That's right. Would you keep the same ratio though within the silver equities versus gold equities as the one that you're keeping with the physical?
Yeah, you might want to be heavier with silver, but again, now with mining assets, you've got to be cognizant of the geographic location. And a lot of people think that Canada and the U.S. is the best location worldwide. And my thought process is, okay, so we get China, we get Russia back or ratio back currencies with gold and silver. And you get a big blow up in the price of gold and silver because of that. And basically, China comes out and says, we have X amount of tons. We're showing you ours, and they're saying to the United States, you say you have 8,133 tons of gold, but it's not been audited since 1956. Prove to us that you have that. And if they don't, if the U.S. doesn't have it, and I highly doubt they do, how would the U.S. government create gold reserves? You're surely not going to go house to house because this country is armed. It's called the Second Amendment. So they're not going to go house to house. What's the easiest way for them to build gold reserves? Nationalize the mining sector. So what I'm saying is, in my opinion, Canada, North America, Canada, and United States are considered the best mining locations, safest. And I'm suggesting that maybe they're not. Maybe they're the least safe. And they'll be targeted first when this thing goes down.
How much gold do you think the U.S.?
How much do I think they have?
Yeah.
Who knows? I mean, any number. I'll just say I highly suspect it's less than what they say. I mean, all you have to do is look at information that is disseminated by the U.S. government, disseminated by governments across the world. It's complete bullshit. So why would the amount of gold that they hold be true and pretty much everything else they say bullshit? I mean, why would they lie to you on everything else? They told you the vaccine was safe and effective. Well, guess what? I mean, they tell you that unemployment is 3.8% in the United States. Really? You don't even have half the population at work here. They tell you inflation's running at, let's go back to the example of Home Alone. They've told you inflation has been low, 2%, 3%, and a couple points in the last couple of years, 5, 6, 7, 8%. But take that $19.83 and put 2.5% inflation to it for 40 years. Does it become $63? No, it doesn't. I mean, governments are lying to you about everything.
Yeah.
Why would they tell you the truth about what they have as far as gold reserves? That's my point.
A friend of mine, his name's Lobo Tigre. He's a mining analyst, and when I talk to him about how to analyze mining stocks and so on and so forth, he always tells me that his motto is assume BS, and you'll never be disappointed. And
right. That's
among the lines of what you're telling me here. But to go back to the gold reserves of the countries, Bill, I'm reading here that the U.S. has 8,100 tons of gold, whereas China has 2,200 tons of gold. So that ratio is, let's just call it 4-1. Let's say the U.S. has 4 times more gold than China. What do you think that ratio is in real life?
I think that it could easily be 5-1. China has more gold than the U.S., 5-1. And that's assuming, okay, so the U.S. didn't totally loot Fort Knox, West Point, Denver, etc. And there's 5,000 tons left. On the back of a napkin, and I did this 6 years ago, on the back of a napkin, I could show you where China had 25,000 metric tons. China mines 400 tons per year internally. That's what they mine. Not 1 ounce leaves the country. So in 10 years, that's 4,000 ounces alone. And just look at what's going into Shanghai, and none of that gold has been exported. They're like a vacuum cleaner. They suck gold in, but none of it ever comes out.
Do you consider Russia an important player in the gold market in terms of reserves as well?
Yeah, I think they probably have. I don't think they're anywhere near what China has, but I think they probably have bought more gold than what they've said publicly.
Hmm.
And I mean, obviously, both Russia and China did not want to come out and say, well, yeah, we bought 3,500 tons last year. We bought total global production for the year, because then you had the risk of military conflict. Those are fighting words. I have no idea. I wouldn't even speculate what Russia has, but I firmly believe they have much more than what they say they have.
Hmm. Do you think they
And
too have
while we're
more
on the
than the
topic,
US?
uh, it's hard to say. I mean, if Russia may have 4,000 or 5,000 tons, they may have more. They may have somewhat less. I mean, they admit to what is it 1,700 tons now for Russia? Is that the number?
Something among those lines. I can check again, but something among
Yeah,
those lines. Yeah.
yeah. Could we have the same amount? Yeah, it's possible.
Hmm.
But while we're on the topic of Russia, if you go back to when Ukraine started, the war hawks were saying, "Well, yeah, we're gonna bankrupt Russia, just like we did back in 1989, 1990." Well, that's pretty much an impossibility, because I think Russia's debt to GDP is 17%.
Hmm.
The U.S. debt to GDP is 125%, and you weren't even born back in the day when I was in college. And in college, we were taught any country that gets to 100% debt to GDP is opening the door and walking through the banana republic door. That's what defined a banana republic 40 years ago.
Hmm.
And now you've got the world's reserve currency at 125% debt to GDP. And the world overall is 300% debt to GDP. The world is a banana republic.
It's funny when you put it that way.
That's math. That's math.
Hmm.
That's not speculation. That's not Bill Holter's opinion. I mean, my opinion 10, 15 years ago, you could argue with it. You can't argue with the math. Just look at the numbers.
Sure. No, that makes sense. What do you make of other commodities in this case when you talk about, or when you think about swinging the swinging pendulum when it comes down to global dominance and it potentially swinging towards the commodity rich East? Do you think they're going to weaponize commodities as well, and therefore all commodities could rise in price?
I think that's pretty much a given.
Hmm.
And I also think that it's a given that China will, and they already have somewhat, weaponized rare earths, because they have such a huge percentage of the rare earth production.
What else? If it's like oil, other stuff?
Well, why would any country not use their advantage, so to speak, to their advantage? I mean, look what China has done over the last 10 years. They've gone all over the world, lending money and making equity investments in real stuff.
Sure. Yeah. That's what the Belt and Road Initiative is right now, right? They've invested what, $10 billion over the first half of this year. I'm eagerly awaiting to see what the total number is going to be for this year, but it's again a record-setting year after year. They're just buying up mines all over the place.
And the BRICS is expanding in January. They've got another 5 or 6 nations, important nations, Saudi Arabia, Iran. I mean, they're joining the BRICS in January.
Yeah. And so you think that, go ahead.
It's just going to get bigger.
Okay.
The BRICS are just going to get bigger. And think about this. Who are the real true allies to the United States throughout the world? Who are they?
I don't know,
Are
the
there
G7?
any? What, are they all allies, really? I mean, the U.S. has torpedoed some allies. The U.S. Torpedoed Australia on a subcontract. We've torpedoed France. We're not honest business partners, is what I'm telling you.
Right. The BRICS thing is a topic in and of itself, potentially another podcast. You told me you only have up until the end of until the top of the hour, so I don't I don't mean to lose all of your time here today. But you do a lot of these interviews. You write a lot. You're out there a lot. You have a lot of opinions. What's something that you would like to talk about, but you haven't been asked before, or something that you think is worth discussing, but that I'm forgetting to bring up?
I've done so many interviews. I think I've been asked almost
Yeah.
almost everything. I would just say, and we kind of touched on this to start. You asked, how do you take advantage of the situation? And my response was, you're not going to take advantage of it. He who loses the least wins. I would just say, become as self-reliant as you possibly can, because we are going to go through a period where life as we knew it is not going to be the same. You could turn your light switch on and maybe there's no electricity. You could open your water spigot. Maybe the water is dirty. Maybe not even any water comes out. With a credit event, grocery stores will be closed. Nothing will function. So I would just say, try to become as self-reliant as you possibly can. And if you live rural and you're able to live with like-minded people, then you want to become tribal, because one guy's going to know how to fix a wound, another guy's going to be able to fix a water pump, et cetera, et cetera. There's going to be different skill sets that no one person can have. So try to become as self-reliant as you can. Have as few counterparties between you and your capital. And I mean, just get yourself right. Get yourself right physically, mentally, spiritually. Be ready for what's going to come. Nobody's going to come out of this better than they were. In the aftermath, yes, there will be some that did own gold, did own silver, had, quote, liquidity to purchase assets that have collapsed in value. But that's for, even if you were able to do that 2-3 years from now, it's going to take a long, long time. Just think about the Great Depression. It took 25 years for the stock market to come back in 1954 to 1929 levels. So this is going to be a long slog, and the easy life that we've had to this point is going to change drastically.
The physically, mentally, and spiritually part, I think, is oftentimes ignored when people talk about these things, because we tend to think about our finances and so on and so forth. But that's a very important point, and thank you for bringing it up. Bill, you used to, just a short note, you moved to Costa Rica in 2006, and you lived there for 5 years. Then you came back when we went back to the US. Is that where you plan on staying? Because you don't sound very bullish in the US as a whole. You do live in Texas, which is sort of a US within the US, if you will. But is that where you plan on staying?
Right. No, where I am now is where I'm going to be. I lived in Costa Rica for 5 years, left at the very end of 2006. I was called, crazy, an idiot, tinfoil hat, you name it, because I saw what was coming in 2007, 8, 9. Moved out of the country. That seemed to pass. They did flood the system with liquidity and blew up their balance sheets. And my Spanish got good enough to understand that when I say we, I'm talking about gringos, are not well liked. And that is the way it is throughout all of Central and South America. They smile at you. They accept your money because they like your money. But in the case of Costa Rica, they use the dollar. Their central bank uses the dollar. That is their buy currency, the Costa Rican colon and the US dollar. And when the dollar collapses, locals are going to point directly at gringos, because who's the wealth? Where is the wealth? The wealth, they believe that even somebody who lives month to month on Social Security, they think they're rich. And there's 2 home invasions every day, or there was. This was 10, 15 years ago. It's probably worse now. But there was 2 home invasions every day that never made statistics because they didn't want to scare tourists away. So when it goes down, if you're a gringo there, you're not going to survive. And I live in Texas now. I live amongst like-minded people, and I'm going to fight this thing, shoulder to shoulder with like-minded people.
Hmm. You don't think there's a place in the world, because I mean, I get your point in Costa Rica. That's what you have as your own personal experience. But do you think there's a place in the world that's safer or safe, not even safer, but just safe as a whole?
If you find it, let me know.
That's a good point. That's a good point. Okay, Bill, this has been fun. Again, I'm keeping you for longer than what you promised me, and I appreciate you investing so much time in me. So thank you so much for doing this. It is billholter.com for people listening who want to read and listen more. And yeah, thank you so much for doing this.